So I'm professor of statistics and data science, and also a professor of computer science at UCLA. So I direct the Trustworthy AI lab. So I think people need a bit trustworthiness in this prediction market, right? So first of all, I want to thank Ishmidi and his team to organize the historical event. And as a statistician, I naturally like this location, Las Vegas, okay? Right. So our recent research discovered that Polymarket and Kalshi are particularly suitable for deploying AI technology, AI tools. This is very different from stock market. Probably you can apply the machine learning, more traditional one. But for this prediction market, the data is of the multimodal case. Say you have text data, tablet data, image data. So all this can be well analyzed by the recent progresses in the AI, okay? So let's see what we discovered using the AI tools. So in any case, we have done very rigorous analysis. As you may tell, I switched the order. I present insider trading first, then arbitrage, then what you see in the agenda. Because I feel people have more enthusiasm, more want to put more attention on the insider trading. Okay, let's see what's the very sensitive market for insider trading. I think number one will be the Israel military market. Okay, that's no question. And that's also the case we are able to discover the confirmed case of insider trading. Basically means that guy got arrested. You can see his name in the newspapers. Okay, we also collaborate with Medium who provide us the non-public information. Say, for example, ongoing lawsuit. So we do have quite a few, which I will show you the confirmed insider trading cases. Okay, so what we did use AI. So look at the data. We have collected in the past 1 year about 1,000 markets for Israel-related prediction market, and that include 186,000 wallet and market pairs, and 58,000 unique wallets. Okay, and the total, the cumulative trading volume is 1.26 billion. It's big enough for us, for our tool to become effective. Right, so basically we categorize the markets into 5 different classes. The first one is a direct military strike events. Say Israel strike Iran by January this year. This can be the ceasefire and the normalization agreement, the second category. The third one is domestic Israel politics and also some other diplomatic developments and the territorial and the governance outcome. So such kind of category also help us, you know. As you can tell, all this stock market is a natural place for the insider trading to develop their whatever strategy, okay? Okay, here are a list of confirmed insider trading. This is not something we use AI to identify. They are just published in the newspaper, okay? And from NPR, Forbes, and Twitter, and as I said, we have a contact with some Medium for some non-public information. We have in total 10. It's not many, but it's good enough for us to fine-tune our AI tool to identify, okay, the potential insider traders. All right, so I want to talk a little bit, say what's the input of the insider, this AI tool. The output is who we identify to be insider trader, that's clear. What's our input? Our input is something called the features. We need to identify some features of the trading patterns. We actually use 9 features. This is not an arbitrary number. We have used many different ways to pin down these 9 features, okay? So none of the features are related to the profitability of that wallet, because later, when you deploy this method to real-time data, you don't know this wallet will be profitable or not, right? So a lot of this survival bias data has been removed, okay? So there are 3 different types of features we will decide the wallet or a cluster of wallet, okay, to be potentially insider trader or not. First one is the byte sizing. I'm glad some speaker mentioned this in his talk. Say how much a trader deploy relative to the rest of the market, maybe half from just one single wallet. A trader who buys an order of magnitude higher, larger than their peers easily stand out, right? Another one is concentration. So how much of wallet's total activity was concentrated into one single market. And of course, the more they concentrate, they are more likely to be, insider, because for a retail trader, they probably tend to be more diversified their investment. And the timing and the velocity, and how quickly a wallet enter and accumulated its position. Okay, so a new wallet is open, buys, and closes within hours of a resolution is highly suspicious. This is just 3 categories. I didn't give you exactly what the features is, but they can be classified into 3 different types. Okay, and all these features were picked by the AI. Okay, we have validated. Okay, let's see what the output of our AI models. So basically, we give each wallet or each cluster of wallets a number. This is called the suspicious score, from 0 to 1. 1 means you're definitely the bad guy, okay? And 0 means you are just innocent, okay? That's a continuous from 0 to 1. We rank them, okay? There are thousands and much. It's 58. Remember, we have 58,000 unique wallets. And by ranking them, we notice that the top 2.5%, that translates into 1,460 wallets out of 58,000, could be potentially the insider trader. Remember that we have a ground truth. We know who is insider trader, who is not. Out of this 1,460 flagged wallets, 8 out of 10 confirmed the case got covered. So we use that information to calibrate and fine-tune our AI tools. Okay, and you might say, okay, there are still like 1,452 wallets who are not identified to be an insider trader, but just you can hold for a second. That information is still useful, especially for the trader who want to do the copy trading. Okay, so the undetected insiders score lower because they behave. Also, okay, so as I said, we identify 8 out of 10 insider traders. There are 2 still not be identified. We unbox that to analyze their behavior because they behave more like experienced traders in the sense they do sustained trading activity, they diversify exposures, there is a smoother and less abrupt position building. Okay, so they really behave like usual traders. That's why we didn't pick them up. Okay, as I mentioned, even we have more than 1,000 people who are potentially not insider traders, but we flag them. But if we look at their profitability, so we compare the top 2% wallet we flagged versus the rest, 97.5% wallets. Their profitability is actually higher. Even I only have a minority of the wallets. They actually make 66%. Okay, the median profit is 13,000 versus $7. If we do a statistical testing, that means significantly different, right? So the mean profit, the top 2.5% is 25,000, and the rest just lose the money. The median ROI, average win rate, they didn't like 90%, but once they win big, okay? And we can see we also have the share of profit. Despite just representing only 2.5% of the population, they still capture more than half of all profit and deploy almost a half of the total capital. This showing the extreme concentration of both gains and activity. Okay, so all right, so we validate our AI to use the historical data, which we know who is insider, who is not. Okay. Now let's deploy it to the real-time data. So today, who is insider traders? That's something a lot of people care about, right? Not history data. Okay, we have made a tool. That's a snapshot of our tool. We give different AI actually make this plot. So it's not a human decided what the weight is for each features. Okay, we still give a suspicious score, just like the historical data. So what we does here, the real-time monitoring to flag inform the traders. They're according to their fresh wallet of the coordinated wallet cluster and unusually large size. We have a long list, okay, and we scan almost 5,000 markets and 2,450 events, and we have 14,000 trades, and we update our topic, okay? So some market is hard to have insider trading, but for some, there indeed has a high probability there's insider trading, okay? And we have different scanning frequency because we scan through the whole Polymarket, okay? So depending on what you need, we have different frequency to scan through the whole market. And I'm happy to share my result on this real-time insider detection. So if you are interested in knowing that, please join my Telegram. I'm free to share all this information, okay? And the reason I do that, not just because I want to make the market more fair, but also I would like you to contribute some confirmed or at least a suspicious insider trading information to me. I have a third party to verify that. No worry. So the more confirmed insider behavior we know, the better our AI tool can be improved. Okay? So that's basically the first part of my talk. My second part is also very interesting. It's about the arbitrage opportunities. I know a lot of people doing trading maybe for profit or for the hygiene. So we carefully analyze the Polymarket NBA game, and we have the paper public, every implementation details in my homepage. So I will invite my lab member Anderson to take over that part. Yeah, please.
Thank you, Professor. Thank you. Hello, everyone. Really happy for being here to share our results. Myself, my interests cover asset pricing, crypto, and prediction market. And today, we're going to present our arbitrage study on Polymarket. And I don't know how many of you have ever searched like a Polymarket trading bot, Kalshi trading bot on GitHub. I mean, if you do that, you will find out there are thousands of trading bots, and most of them are doing arbitrage. So, and we are curious, like even though like there are so many open source code to use, you can, and right now if you want to rent a server, it's super cheap. So, but we are still curious, like is there still any arbitrage opportunity? So that's what we are doing first. The most obvious, like a no-brainer arbitrage is like a single market arbitrage. So very easy, just yes and no. And if like the ask price for both outcomes, the total less than $1, you just buy both of them. And like if the total of bid prices is larger than $1, you can split your token, you can split and then sell both. So that's what we are doing first. As you can see here, compared to previous academic research, so our innovations are, we are not like just using trading volume, because if you search previous like academic papers, they just use trading volume as a proxy to estimate what's the arbitrage volume. But we are utilizing order book snapshots. So we receive streaming data from WebSockets and persist them on our disk, and then we reconstruct order book snapshots, and then we detect, okay, so under any snapshots, if there are any arbitrage opportunity, and we will also estimate what's the duration for that arbitrage opportunity. And at the end, we don't want to, consider, like a dust opportunity, which means like it's like the volume, the dollar value is really tiny. So we set like a minimum liquidity as like a $10. All right, next. So this is our result. We collect data from February to March, and we analyze 173 NBA games. So there are like 3,042 markets, and there are like a lot more markets than game, because as we know, and for any like sport game, there are money lines, there are spreads, there are totals. So the total number of markets are much larger than the number of games. And okay, so at the end, we found 7 arbitrage episodes. So each time when arbitrage, we find arbitrage, we call it an episode. So we found 7 episodes, and the medium duration is just 3.6 seconds. And as you can see, as we expected, there are really few, simple single market arbitrage opportunities as we expected. And if we, inspect these, detected opportunities, they are all, as you can see in the right graph, they are all in the game. They are all in the game. So which is, consistent with traditional asset pricing theory. So as you might observe on, stock market, stock prices, most of the time the prices are pretty calm. But when shock comes, you will see, the previous pricing, the equilibrium will be disrupted, and you will see jump. Yeah, have you heard of any hedge fund named Jump Trading? It's very famous. Like it's based in Chicago. So basically, as you can see in ABA games, especially if at the fourth quarter, some star player goes off and throw in some 3-pointers, and will suddenly the price will jump a lot. And so in that transient moment, and there will be highly likely you will see arbitrage opportunities like this, a market microstructure, right? So, but we can't just be satisfied and stop here, because besides single market arbitrage, there are thanks to more complicated structure of sports books, sport market, and prediction market, we got combinatorial arbitrage opportunities. So take this for example. Let's say we have NBA game Magic versus Cavaliers, and we know that spread is a subset of the money line. So theoretically, the spread price must be lower than the money line price. But each market is traded, and separately. So there are situations where the spread trades higher than the money line, and if that happens, the order book is broken. So if we can buy Cavaliers money line, and at the same time we buy Magic plus 1.5 spread, and if both us, the total of both us drops below $1, then we can have guaranteed $1 payout, but the cost is less than $1. So and we just again, let me jump to the result. So okay, this is just a methodology how we construct our backtest on combinatorial arbitrage. So basically, we just unified all timelines, all events on a unified event timeline. And so here's the result. So we, again, same data set, same time period, same time window from February to March, 170 games. And we found 290 episodes compared to 7 episodes in single market result. And the median duration is 11 seconds, much longer than we expected. And most of them, as you can see, are in the game. So again, combinatorial arbitrage, I forgot to mention that. If you check all of those automatic trading bots on GitHub, most of them won't give you, combinatorial arbitrage, because it takes, because the complexity is exponentially, growing. If you want to, given any streaming data from WebSockets, you want to check all possible combinatorial arbitrages across all markets on Polymarket is really hard. You need some edge on your algorithm to quickly check if there's combinatorial arbitrage, and you need to react very fast. So that's why until very recently we can still see many such combinatorial arbitrage opportunities. But as you can see, if you look at the profit statistics, the median episode just gives you like a $0.4, and so it's not like, you know, there's not, I won't say there's like a gold mine, like a huge you know, opportunities for you to monetize. So and also this study is like more like academic rather than, you know, hedge fund, you know, like industry research. So we just want to, you know, like get some insights on, you know, how many, you know, how much, you know, how mature prediction market, how many Polymarket is right now. So my comment is, I don't know if you have ever read a book called Flash Boys. So at like around 2000s, you know, there are, for stocks are traded on, you know, were traded on different exchanges. And those hedge funds, they will just, you know, buy low, sell high, same stock on different exchanges. It's like a no-brainer. And, you know, like at the end, every like hedge fund just co-located their servers, you know, with, you know, exchanges, and try to get the fastest speed. But, you know, as time goes on, you know, people tend to find, you know, like do statistical arbitrage, and that's, you know what, even still right now, there are new like equity statistical arbitrage, you know, strategies coming up every day. So I would say, you know, it's the same story here on prediction markets. Like such obvious no-brainer arbitrage opportunities, they still exist, but they, you know, like they will eventually like fade away, you know, like given highly, you know, competitive like hardware, you know, like races. But, you know, statistical arbitrage, they will always exist. They will always exist, and it doesn't like depend heavily on your hardware. It's more like your algorithm, like a grid trading, Kalman filter. You know, like it's, if you, and like, you know, and you can also relate prediction market with real stock price. For example, like let's say there's an event named how many Model Y will be delivered in the next quarter, and, you know, of course it's highly correlated with Tesla stock price, even it's a meme stock right now. So you can, you know, if you want, there are so many correlations that you can, you know, you can leverage. Right. So that's all about, like, pretty all about my presentation. Thank you, like, for listening. And if you want to get in touch with us, like, this is our email. This is a professor's email, and then you can always email to us. And finally, like, again, let me show the QR code again. Please scan and to join our Telegram channel to get like our beta testing of insider detection alerts. And finally, like, is there any question?